My name is John Bykowski. I'm president of the American Association of Individual Investors, and I will serve as the moderator tonight. We have a very special guest tonight, Charles Rotblut. Charles is the editor of the AAII Journal, author of the book, Better Good Than Lucky, and he's also the creator behind the VMQ Stock service. But most importantly, he is my Strava buddy. Would you please welcome Charles?
Good to see you, John. A little bit chilly to get our miles in this week.
That has been a cold get together. I mean, over the last year, since the association has been largely working from home, we've used Strava as a way of keeping kind of, I guess, motivating each other to kind of get out and exercise and whatnot. So it's always kind of fun to watch what the activities that Charles does, and most importantly, I think some of the descriptions of the activities. I always know what temperature it is, and what he's wearing, and have you encountered any interesting people along his path?
Well, yeah, I try to make it a little bit more interesting, and just be a little bit more, add a little more fun. If I'm gonna, just saying morning walk seems so boring when you could say, morning walk, saw a loose glove lying around on the ground. It just adds some color.
I agree. It's been kind of, we've had this cold wave here in Chicago. Have you been able to get out a little bit and brave the cold?
I actually went out last night because the temperature was 3, so I figured it was positive. It did take me about 25 minutes to actually get a little bit warm. After that, it was fine, but certainly that first 10 or 15 minutes was a little brutal.
Yeah, it is. Although, what I find is a lot of it is mindset. I know that, who would think that we would want to actively get out in this cold weather and exercise and work out, but once you get the right clothing and the mindset and you get out there, it actually feels pretty good afterwards, doesn't it?
Yeah, absolutely. I've noticed that relative to, say, a year ago when we started working from home, my tolerance for cold has definitely gone up quite a bit. And we've talked, I'm actually able to get away wearing a lot less in terms of layers now relative to what I would have done a year ago.
Very much so. So, you have a very interesting presentation here tonight, but before we get started with our presentation, perhaps you can just tell us a little bit about, the whole inspiration behind the VMQ service and what got you going on this path.
Yeah, certainly. This actually started almost an extension of my book, Better Good Than Lucky. And I was really looking for a systematic approach to picking stocks. And the strategy I laid out in that book is actually a really good strategy, but I did find it at times to be a little bit too restrictive. So I really went back and looked at the academic research, looked at the industry research to find out if I really wanted to narrow down my focus, what big characteristics would actually lead to higher returns over the long term. And that was kind of the genesis for this. But I got to give credit to John too. John gave me a lot of inspiration, really encouraged me to kind of go through this, and it was a great sounding board through this whole process, and assisting me with the testing and the creation of VMQ.
Well, like Charles, I'm a big fan of evidence-based investing. And the fun thing about the VMQ service is that really, you settled on the 3 primary factors that you really think are 3 of the strongest factors that help individuals pick interesting stocks. So I think, in that context, I think the VMQ really kind of matches your personality. I love the fact that it's all evidence-based, and the beauty of watching Charles, implement the strategy is he's a very good rules follower. I mean, one of the things you do is, you work hard to figure out what are the good procedures to determine what stocks are attractive and interesting, and by the same token, what are the right things to take into account when you want to sell a stock. And the thing about any system, and the challenge with any system, is that, especially when talking about factor investing, is it could take many years, it could take a decade for really the long-term factors to come into play. And you have to have a good belief, understanding that the system will come into play and will work in your favor. And if you don't have that belief to begin with, it probably is going to kind of harm you along the way.
Yeah, absolutely. It's interesting you said it, because I'm reading a book right now. They're talking about Sir John Templeton, and one of the things he's talking about is just his belief and his willingness to just be different, but really be absolute in his beliefs, and know that he was actually making investments where the payoff was so large compared to the potential downside risk, that it was worth it for him to really stick his neck out and take some of those big gambles. And certainly not a trait that a lot of people have, and certainly not the wherewithal to withstand some of the gambles he took.
Very interesting. So I'm going to let you get started with your presentation, but I'm going to remind our audience that we are recording this. The recording will be made available tomorrow. Also, the slides are available for download, and an email will go out with the slide handouts as well. So Charles, I'm going to sit back. I'm going to be watching the audience for questions. Feel free to stop me if you have any, if you want to get any read of what people are saying, or if they have any difficulties with anything. But otherwise, I'm going to sit back and enjoy your presentation. Thank you very much.
Great, thanks, John. Thank you, everybody, for joining us today here in chilly Chicago. I haven't checked the temperature, but it's probably around 2 or 3 degrees outside. So nice of you all to join us in this nice warm environment. So today I'm going to talk to you about, John said, about factor investing, and it really comes down to taking a step back about being a truly active investor. And what do we mean by being active? It doesn't mean that you're trading night and day. It really means that you're doing something different than a traditional market cap weighted index. Now, if you want the performance of the market, that's fine. There's nothing inherently wrong with it. But an index fund like the Vanguard, or perhaps you use an iShares or State Street Spider, or I think there's about 15 or so mutual funds that track the S&P 500. If that's the return you want, that's fine. There's ways you can do it. And in fact, our founder, Jim Clinton, actually recommended using an equally weighted index to get the market exposure. But if you don't want the returns of the market, then you have to realize that you need to be different. And I just mentioned John Templeton as one example. And if you really look at some of the investors have really good long-term performance, one trait they have in common, even when their investment strategies differ, is this willingness to not look like the market, to actually have portfolios that differ than the market. And VMQ is one such approach. And part of the reason why we talk about being different, it is something that we individual investors can do, but a lot of money managers can't. Because when you're managing money for other people, you always have this dilemma of doing what's going to keep your clients happy and doing what you know is going to work over the long term. And I've been in conferences and I've seen this playing out in Q&A where someone's talking about a strategy with really good long-term performance, such as value. And I've seen portfolio managers in the audience say, you know, I agree with everything you're saying, but my clients are not going to withstand me undergoing periods of underperformance. And a lot of these professional money managers often get judged on 3-year performance. So sometimes you might hear people in the industry talk about the smart money. Well, the reality is the smart money isn't so smart. A lot of times the smart money is actually short-term money because they're really concerned about how their manager is performing against a benchmark versus wanting to allocate towards strategies that have really good long-term payoffs. And so that's one of our big advantages of being individual investors, is that we're not going to get fired because of how our portfolio returns. So it gives us the ability to really take advantage of some of these strategies that a lot of professional money managers can't do, even though they know it's what they should do over the long term. And so this is what gives us our advantages, is never having to report performance, and the ability to really invest in stocks of any size and really any stocks we want to. And I can't begin to emphasize how big an advantage this is. And if you go back and you look at Jim Clinton's, our founders, what he was writing over the years, and when he's talking about the advantages that individual investors have, it really came down to this, is really being able to do things and follow strategies that worked over the long term and never having to worry about reporting what you're doing to anybody else. Now, granted, your spouse might have a word or two, but when you think about professional money managers, they really can't do this. They're always beholden to their clients, and they're always concerned about what's known as career risk. We individual investors really have this ability to be truly different, and it's a massive advantage for those of us who are willing to follow evidence-based, disciplined, systematic, long-term strategies. So if you're going to be an active investor, what are some of the keys? Well, John started off talking about following an evidence-based approach. And it really is looking at the research. What has worked historically? There's a lot of research published by academia. There's a lot of research published by the investment industry. And as individual investors, we don't have to reinvent the wheel. We just have to simply decide what type of tire do I want to put on the wheel. I was actually reading about another famous investor who's talking about how he liked to clone the successful investors before him. And it really, as individual investors, you can look at the research and decide what parts of other successful strategies do I want to use for my own approach. But it's really important to be systematic. When we were in the office, I used to always use the term trust the strategy. If you have a really good, well thought out strategy that's evidence-based, you need to trust it, because over the long term, that strategy will work. And again, you cannot be afraid to underperform over the short term. Even the best investors go through periods of underperformance. It's very easy to forget now, but if you go towards the .com era, people were questioning openly Warren Buffett, wondering whether or not he has lost it. We know since then, Warren Buffett's wealth has only grown immensely. So you cannot be afraid of being out of favor if you know the evidence points to long-term outperformance, and it points to that if you're willing to undergo those shorter-term periods of underperformance, the payoff is going to be pretty large and really compensate you for doing so. And one of the ways you can do this is focus on factors. So what is a factor? In academic terms, they call it an anomaly. It basically is that if you look at the risk-adjusted return of a stock, something that does not explain its performance. In more layman's terms, it's characteristics of stocks that have been shown to lead to long-term outperformance. I've shown some of the ones on the screen that are some of the biggest ones. Value beats growth over the long term. Stocks that have outperformed momentum tend to continue outperforming for periods of a year or longer. Good quality stocks are fundamentally sound. And we can even look at size. Stocks that tend to be smaller, particularly stocks that tend to be smaller and be value-oriented, tend to outperform as well. And there's a lot of academic research showing these things work over the long term. In the investment industry, they like to talk about Eugene Fama and Kenneth French, the Fama-French factors. Eugene Fama is a Nobel Prize laureate over here at the University of Chicago. He's the one who originally found the original factors, the idea that value works, size works. He's extended the factors, but he really launched this idea of doing things. Here at AAII, Jim Clunan, our founder, really one of the first people to really embrace factors. Our shadow stock portfolio is one of the oldest and longest running factor-based portfolios. VMQ is an extension of that. And it differs because of what we use versus a shadow stock portfolio. And I'll actually get into those factors. But what it really is at its heart is a systematic approach of using factors. It's a so-called smart beta approach. And it's truly an example of how individual investors can take this research and apply it in a systematic way in a portfolio they can actually use themselves. So it's not some type of black box where maybe if you buy a factor-based ETF, you might be scratching your head, not really sure what the portfolio does. One of the beauty at AAII is that we're very transparent with our approaches and very transparent with our portfolios, because we want you to actually learn from what you're doing and have the ability to either apply it the way we're applying it or take its lessons, and maybe you take part of the portfolio and then you use it in a manner that suits you best. So let's talk about VMQ. It's really based on two cornerstones: the idea of low value and strong momentum. Buy stocks that are both bargains and outperforming. And I'll explain both. First of all, value. I talked a moment ago about how value is a factor. We know over the long term, value beats growth. And it really doesn't matter what indicator value you use. As you can see on the slide, price to book, low price to book beats high price to book. Cheap price to earnings beats expensive price to earnings. Low price to cash flow beats high price to cash flow. You can go across the board and we see this where low value beats high value over the long term. And the margin by which value wins over the long term is pretty substantial, as you can see on the screen. And I like to say there's a simple reason why. Is that when you have high valuations, it typically means investors are excited about the stock. They tend to think that there's something really good going on, and so they want to buy the stock. And so that pushes up expectations. But we all know from economics there's a law of supply and demand. And when it comes to stocks, we know that when expectations get really high and people are buying the stocks, it pushes the price up really high, it pushes the valuation really high. And so what happens is you get to this point where expectations are really high and a company might report good but not great results. And we know there's a difference between good and great. So when you have a company that's priced at a very high premium and it reports that results that are good but are not great, it can fall. So the loftier the valuation there is, the more room there is for disappointment. And that room for disappointment can cause a stock to tumble. Now with value stocks, people tend to overlook them and they don't tend to expect great things from a value company. So when you have a value company report really good earnings, its stock starts to rise. But because people tend to anchor the perception on what a stock was instead of what it is, and there's actually a lag in a reaction time. And so you can actually have this cycle through several quarters where stock that's valued actually does really well over several quarters and people start to buy it and bid up the valuation. And I like to say one of my favorite reasons to sell is a high valuation, because it means a stock that was once valued has suddenly become popular, and that means the price has actually risen by a large amount. So how do we use value? Well, there's a few ways you can do it. The academics like to use what's known as relative valuation. So they take all the stocks and they consider how does each stock's valuation compare to another's. So perhaps a stock's valuation puts in the lowest 20% of all stocks, makes it cheapest 20%. Maybe take another stock that's a very high valuation, and maybe its valuation's in the 80th percentile. And so what they're basically looking to say is which stocks are the cheapest, which stocks are the most expensive, and which stocks are kind of right in the middle. Now, you could use absolute limits. Benjamin Graham, Warren Buffett's mentor, he suggests in his book, The Intelligent Investor, you could look for a price to book of no more than, say, 3, and perhaps a price to earnings ratio no more than, say, 18 or 20. So his idea was setting these set limits of criteria. Both can work. When you're using an absolute criteria, such as I will not pay a price to book more than 3.0, and means you will never overpay for a stock, but say when the stock market gets really expensive, you may not find as many stocks, or when the stock market gets really cheap, you might find a lot of stocks. With relative valuations, regardless of where the stock market is, you'll always find stocks. But what it means is that on an absolute basis, during bull markets, particularly when there's been an extended run, you might pay more for a stock on an absolute basis. But during periods when the market's in a bear market, you might pay less for a bear market. So your absolute criteria moves. One's not necessarily better than the other. It's just two different ways of approaching it. But either way, it's important to realize that some stocks are cheap for a reason. Ultimately, as value investors, we want stocks that are cheap for a reason. It doesn't matter if they have dents, dings, or rust spots. We just want stocks that are priced below what we can reasonably expect another investor to pay for them in the future. Now, we don't have to know what that price is another investor will pay. We just simply have to know that that price is above what we're buying the stock for right now. And with value measures, you can actually combine different value measures. For VMQ, we actually combine 6 different valuation measures. We look at price to sales, price to earnings, enterprise value to EBITDA, which is basically looking at total capital invested in a stock, both debt and equity, divided by earnings before interest, taxes, depreciation, and amortization. EBITDA is basically a proxy for cash flow. We look at shareholder yield, basically what is the company returning to investors, both in stock buybacks and yield, the price to book ratio, and then we also look at price to free cash flow. So we're looking at different measures because a stock might be very cheap on one and expensive on the others, or vice versa. So to do this, we use a 2-step process. First of all, we look at a stock's rank on a given valuation ratio. So this is for Quanta Services, and you're looking right here, the ticker symbol is PWR. On its price to sales ratio is 0.93. That ranks in the bottom quartile of all stocks. So based on this, Quanta is actually pretty cheap relative to all stocks. And then we repeat this for all the other valuation criteria. So going back to this, say a stock has valid ratios for all these criteria. We look at the rank for each individual criteria. And then we figure, okay, so then we look at the average of all those criteria. How does the average of its ranking for each criteria compare to the average for all other stocks? So in this case, if we look across Quanta's valuation ratios and we see how it compares based on each ratio, we take the average of that, say of all 6 ratios, then we look at the average ranking of all 6 ratios compared to the average ranking of all other stocks. So we can see for Quanta, overall, its average valuation is 29th. So what the average of all those criteria are telling us is that relative to all other stocks, Quanta ranks in the bottom 30% of all stocks. So for the VMQ portfolio, we're looking for stocks that rate in the bottom 40% of all stocks. And if you look at the criteria, basically, it's really the bottom 2 quintiles. So if you look at the bottom 20% and the bottom 40% in terms of valuation, or if it's easier to think about, the cheapest 20% and the next cheapest 20%, those are stocks that tend to outperform. So that's how we base our value scores. We're basically looking for stocks on a blended basis that are cheap overall relative to the overall universe of stocks. And so in calculating our value score, we don't necessarily require stock to have valid ratios for all 6 criteria. It's great when they do, but we want at least 2. And our rationale is we think it's better to cast a wider net than to be very specific, because maybe a stock, maybe it's issuing a lot of shares, and as a result has a negative shareholder yield. Maybe, perhaps it's a negative book value for something it's doing, or maybe it had a bad quarter because of the coronavirus, so its price to earnings negative. So rather than rule out a stock for one criteria, we're looking at casting a wider net. So it gives us more stocks to look at. So we consider the 6, and again, we go through that 2-step process of first considering the percentage rankings and then doing the average valuation. And so basically we're using a composite valuation to determine which stocks are cheap and which stocks are expensive. But what I will say about valuation, even though I myself am a value investor and I truly believe in it, value droughts can occur. We've seen over the past few years, as you can see here, it doesn't matter which valuation ratio you look at, whether it's price to book, price to earnings, some other valuation measure, we've seen growth stocks outperform. So even though value has really good long-term performance, no single factor and no single style of investing is going to work all the time. And while some people might view that as being a bug, I'm going to quote Cliff Ness of investment firm AQR Capital, who says it's actually a feature. And that may sound counterintuitive, but if you have a factor that causes people not to actually use it because they're fearful of underperforming, that's actually a benefit because it means over the long term, the factor is going to continue outperforming. One of the worst things you can have in investing is a crowded trade. So when everybody's following the same strategy, that strategy loses its effectiveness. You have too many people doing the same thing, that takes away the return premium. So you actually want strategies that are harder to follow, either because people's emotions, either because money managers are worried about being fired from their clients, or people look at it and say, well, that strategy will go through periods of underperformance. I don't want to take that risk. That allows the strategy to work over the long term. So even though you can have these bouts of short-term being uncomfortable over the short term, if you're a believer and you pay attention to long-term records and you believe that what's caused that factor to work in the past is going to continue to work in the future, in this case, value, we know there's a lot of behavioral finance reasons why it works. We also know there's economical reason why it works, meaning that assets are priced below what they should be. Then you actually want to embrace it and you want to realize that actually works to your favor. But again, you do have to be emotionally comfortable with it. John, before I get into momentum, are there any questions that have popped up?
Yeah, certainly, Charles. Let's see here. Well, you answered probably some of them, but I mean, one of the big questions was, you know, what is long-term versus short-term when it comes to underperformance and, you know, believing in a system. But you probably did address that, but I saw a lot of questions regarding that and concerns over that. You know, have things changed? Perhaps one derivative question that I have here is, you know, what about things like price to book? You know, a lot of academic studies have come out that perhaps price to book is not as meaningful today as it was in the past, yet it is part of the value scoring system. Any comments or observations?
Yes, there's two aspects to it. We've known value, it tends to actually have underperformance. Usually a lot shorter than it's had now. It's, you know, since 2010, it's really had a run where it hasn't underperformed. Previously, periods of underperformance have been less. And there's a lot of actually research. You know, John, you wrote about it last year. And about the time you wrote about it, I saw other people writing, including Jim O'Shaughnessy's firm. Some other people come out where you look at the relative difference between stocks that have low price to books and stocks that have high price to books. That spread has really widened. If you think of it as a rubber band, it's really become too stretched. And although rubber bands can break, there's really a lot of thought that it's going to bounce back. And so we see this also in economics. When things become too stretched, they tend to go back towards the middle. So there's a lot of thought right now that valuations have really swung too far one way in order to come back. Now in price to book, it is a lot of debate about whether or not price to book has changed, particularly because a lot of companies have intangible value. You can look at things like network effect, whether we're talking about companies like Amazon or maybe perhaps MasterCard. We could certainly talk about Apple. I happen to be personally very glued into the Apple ecostructure. But the academic research still holds price to book has a role. I really haven't seen anything that says that really hasn't worked. And if you actually look since the coronavirus bear market ended, we've seen stocks and strategies that use low price to book have actually started to come back. So we are seeing that coming through. But with our value strategy, we are using different methodologies. So we're not betting on one single indicator, we're spreading it out. And for some stocks, price to book does still work really well. For others, price to earnings are doing. So by using a blend of value indicators, we're not sticking our pole and saying solely price to book. We're actually considering several different indicators of value to really get more of a comprehensive overall view. Is the stock cheap or is it pricey?
You know, when it comes to active management versus passive management, you know, a member here notes that experience shows that a large percentage of mutual funds really hardly beat or even match the performance of index funds. What's the incentive of using, you know, either any kind of beta funds or any kind of actively managed strategies?
Yeah, that's very true. A lot of it's really hard to be a passive fund. Now, part of that underperformance has to do with fees. Even the late Jack Bogle used to talk about how fund managers have a hard time getting over fees. But when you actually start digging, you find is a lot of these funds are also tend to be plotted indexers. So if you look at the performance of their funds relative to the performance of the S&P 500, there's actually the regressions are actually pretty close. So even though they say they're investing different, a lot of them really aren't. But I will say that if you're going to veer from following the index, you need to be really disciplined. And one of the advantages of quantitative strategies is they do take the emotional component out of the decision process. You do hear fund managers talk about how they interview CEOs and they get a lot of value out of doing so. There's a lot of research that says you actually shouldn't do it. So you can went to be an active investor, but the real key is to A, be evidence-based in your approach, and be very systematic in your approach. Whether using factors or something else, really having this approach that's well thought out, that's repeatable, that can be done over and over. So it's not really relying on your ability to just judge a company, but really have a set list of criteria that you're every time you're looking at the company, you're working through this list. There's some very good long-term value investors that actually embrace checklists, for instance. Others really take a quantitative approach. So it's really about what's your systematic approach. If you look at the shadow stock portfolio, it is an active approach, but Jim Clune over the years, and now John's taken over the portfolio, very clear set rules that we follow over and over. And that's why the model shadow stock portfolio has done so well over the long term, even after costs are factored in. It is because it's a systematic, evidence-based approach.
Well, I've got a member here, in Roger. So what would you say to a member who, looking back at what he learned in college, hasn't been too applicable to him in life? He's more of a fan of William O'Neill. And what would you say to someone who perhaps is a little bit distrustful of academic studies and would prefer more of a pure momentum strategy?
Well, I would say, first of all, go look at the academic studies yourself. You can go to Ken French's website. We'll make sure we put that in the show notes, where you can actually download all the data yourself. He has information on all the factors plus more. And it goes back decades. You can actually see the numbers yourself. The other thing is, take a look at the industry research. There's a lot of it that's available, and it supports what the academic research says. But I will say, though, if someone has this, he's following William O'Neill, we have CanSlim screens on AAII.com. If that works for you, by all means, use it. We want people to follow strategies that believe in your strategies, and I think it's really important that you're comfortable with the strategy that you're following, because not every strategy is right for every person. And I like to say the optimal strategy is the strategy you're going to stick to no matter what the market's doing. But like I said, if you're worried about the academic research, it's available. You can download the actual returns and do your own analysis and see for yourself what the data is showing.
And I've got two questions here that are related, so I'll let you answer these two, and then we'll let you continue on. How do you take into account sectors or sector information? Because some of these ratios are perhaps sector dependent, or price to sales may be different for one sector versus another. Do you take those into account when using the scoring?
We don't, because we're using a blended approach. It really kind of balances it out. So if a stock stays cheap on prices or sales, but it's really expensive price of earnings, they'll offset each other. So we're really looking at that blend approach. Are they cheap overall versus just one indicator? So we don't worry about it so much. Is it cheap on price to sales, or is it cheap on price to earnings? We really want that comprehensive overview of the stock.
Very good. Well, I'll keep watching the questions that come in, and I'm sure we'll have time at the end to get some more questions going.
Absolutely. Thank you, John.
Welcome.
Okay, so now I'm going to talk about momentum. So value, we were talking about what's cheap and what's underpriced. Momentum looks for what's outperforming now. So value is, I like what's cheap. Momentum is, I like what's winning. And momentum works really well, and it's really about relative price strength, and we'll get to that in a minute. But as you can see It doesn't matter if you look at small companies or if you look at large companies, stocks that have outperformed in the past continue to outperform for periods of a year or longer. And as you can see here, the benefit for buying stocks with strong price momentum over stocks with weak price momentum is very large, huge premiums for buying momentum stocks, stocks with strong price momentum. And I mentioned the Ken French database before. This chart's directly from his data. We'll have it in his show notes, but again, you can download it and run your own numbers. So the idea of momentum is based on this concept of relative strength. So if you take all the stocks and you look how they performed over a given period, relative to all other stocks or relative to an index, say the S&P 500, the stocks that outperform the most are considered to have the strongest momentum. And so what you're really looking for is stocks in the top 2 quintiles, the stocks that have above average price performance relative to all other stocks. Those stocks tend to outperform, and they tend to outperform if you're measuring on periods of 13 weeks, 26 weeks, or 52 weeks. Now, over very short-term periods, they can be mean reverting, meaning that they can go to underperforming. So you start to see some of this academic research that says, we'll look at performance over the last 12 months, but we'll throw out the last month. I've talked to Jim O'Shaughnessy, I've talked to his son Patrick. They've actually looked at the data looking at the full 12-month period. So this is a case where academics said one thing. I talked to people in the industry where they actually said another thing. Yes, it works. We do. I'll show you how we track in a moment here. We do consider all 12 months, but the big thing is if a stock has been outperforming, it's likely to continue outperforming. Now, although momentum works really well, it can lead to more turnover than low value strategies. So you do have more transactions with momentum, but you still get higher return with it. So the way we measure momentum is we use what's known as a weighted 4-quarter relative strength index. That's a lot of words. So let me try and explain to you what we do here. I just said a moment ago that relative strength works well when you measure it over 52-week periods. So we actually look over a 52-week period, but versus considering how a stock's price performance was over the last 52-week periods, meaning how does the stock's price compare now relative to a year ago, and how does that price gain or price drop compare to all other stocks, we actually break it into 4 separate quarterly periods. And then we assign weightings. So if we go back, say to 4 quarters ago, really 3 quarters ago, that 4th quarter, or I'll make it easy. I'll say the last quarter of the last 52 weeks, we'll give that a 20% weighting, a 20% weighting to the next quarter, a 20% weighting to the next quarter. And then finally, for the most recent quarter, we'll assign a 40% weighting. So we're giving emphasis to the most recent quarter, but most of the indicators are looking at the performance over the previous 39 weekly periods. And so we're really looking for a stock that's outperforming the last 52-week periods, but we're trying to avoid those stocks that have done really well the last 52-week periods, but maybe that price performance, that huge price performance is back in it. So it had really big gains, say, earlier in this period, but when you get towards the most recent period, there's been a huge drop. So we're really trying to find stocks, give weight to stocks that have recent outperformance. And yeah, an ideal stock is a stock that's trended upwards. This is power here, but we're really, again, looking for this. Now, when sometimes people see us adding stocks to VMQ, they might say, well, that stock's had a big run up recently. That's because we are giving a little more emphasis to the most recent 13-week period with how we do the weighting. But our research, when we've done the analysis, we found out that this actually works better than using a 52-week period. So I'll go back to this. And granted, it'd be easier if I was presenting in person with a laser pointer, but if we were to actually measure relative strength over the whole 52-week period versus chopping it up into 4 different periods, we'd actually do worse if we took the whole period than if we actually looked chopping it up. So actually segmenting it gives us better performance. And when we looked at combine this with value and with our quality indicator, we actually found out it fared better over 26-week periods. It fared better if we used a blended approach where, hey, what if we assign a 50% weighting to 26-week relative strength and a 50% chance weighting to the 52-week period, or if we just use a pure 52-week period to measure relative strength, we found this weighted 4-quarter relative strength rank. Even though it's a little bit more complicated, a little bit tougher to explain, we found out this actually works better. This actually gives us better returns. Now, like value, momentum can have periods where it underperforms. We particularly see this occur when there's been a big drop in the market. When you look at the 5 worst crashes, it really has occurred during pretty severe bear markets, during the Great Depression, during a tech bubble crash, during a financial, crisis. And what they found happens is that the stocks have done well heading into the bear markets tend to lag overall. So what happens is stocks that fared worse going to the bear market, you suddenly have a turnaround. And a good example, if you look at housing stocks or real estate stocks going to the financial crisis near the bottom of it, March 2009, they were doing terrible. Everyone thought the companies were going to go bankrupt. They're leaving them, I don't have anything for the stock. People are going really conservative. The market hit the bottom in March 2009, and all of a sudden you had all this money pouring back into them because people realized these companies are not going to go bankrupt. I should shift and get into it while the getting's good. So we had a sudden shift from being really safe to being really risky. And because momentum by itself is a backward-looking indicator, it's always a lagging indicator, but so are other things such as value or growth. You have the sudden turn, so it takes a little while for momentum indicators to actually churn and catch up onto it. So again, it doesn't work 100% of the time, and because there is this risk that you might get caught in a period of underperformance, that makes momentum harder to follow, and that is a feature, not a bug. And again, it's a little different mindset, but by investing differently, that's where you get this long-term outperformance. Now, I did talk about how value momentum are different, and you're seeing right now, I'm talking about buying what's doing well versus what's buying what's cheap, but they actually work really well together because they are opposite factors, and they actually, as factors tend to be uncorrelated, they pair really well together. And what I like to say is that when you have a stock with strong momentum and a low valuation, it's really using the market's efficiency to your advantage. So the idea of efficient markets is that really the market's always right, that the market's taking all known information and pricing it into stocks. So the price of the stock at a given moment is always correct. Now we know, about a week or so ago that GameStop priced at $400 wasn't that efficiently priced. But we know over the long term, the market does tend to get things more right than wrong. And that is an argument for index investing. But we know it's not fully efficient. And what I like to say when you combine value momentum, what it tells you is that other investors are looking at value stock and realizing that value stock is underpriced and that value stock is probably a bargain. So it's actually using market efficiency to your advantage by looking around for confirmation that yes, this stock truly is a bargain and other people are recognizing this stock. So another way to think about it is when you combine momentum with value, you're avoiding the so-called value trap where stocks look cheap, but then they stay cheap and they don't rebound in price. John, I know I just went over a lot with momentum, so before I move into quality, are there any questions I can answer? Because I know it's quite a mouthful.
Let me turn my mic here on. Certainly. Well, I guess a couple of questions have come out, like, when it comes to the weighted momentum, how do you have any background on, why it's 20-20 40 as opposed to some other percentage range?
Yeah, so that's how we actually did it in our Stock Investor Pro program. And again, the whole idea is, let me go back to this actually, is that we're actually trying to give emphasis to this 13-week period. So we're really just trying to give weighting towards this average one. But Beyond that, we're not really trying to play favorites here. So we're trying to actually take mostly advantage of that 52-week period, but applying it. Now, have we tested other weights if we try to optimize it, saying, again, maybe some other mix? Could it possibly work? Absolutely. But we're using this, and John, I don't know if you know some of the background behind this, but if you can add anything else to this.
The only color I could add on, I know that when we first started offering Stock Investor, it was one of the calculations that was provided to us by our data vendor. So we've kind of kept it in the whole time. But I guess the notion is that you want to give a little bit extra weight to the most recent quarter and just a little bit less extra, little bit weight to some of the prior periods. So I think it's just a little bit more emphasis on the most recent while still considering some of the longer term performance.
Great, thank you.
In terms of does price or trading in and out of momentum eliminate the premium you get in using a momentum strategy? The cost of trading momentum?
It doesn't. I mean, I think with anything like this, if you trade too frequently, you do have that, but it actually doesn't. There's been research into it. You get enough premium where it really doesn't make a difference. But for most individual investors, price really isn't too much of an issue. Excuse me, especially right now, because we have no commissions. You still have your bid-ask spreads, but for individual investors, it's usually not too bad. But I've looked at research from institutional investors and large investing firms, and the research I've seen, particularly from AQR Capital, which is a big embracer of factor strategies, is that really you do not lose much cost by doing momentum strategies.
And a member had asked if you could explain the slide 22 a little bit more carefully, and that's the one that has the different periods of momentum crashes.
Right, and so this basically, so I'll walk through. This is actually from a study here. And so
especially if you could explain the column headings, what they mean specifically.
Yeah, absolutely. So the market returns 2 years prior is what the market was doing 2 years prior to the bottom. So it's really the performance of the market heading into the bottom. And so you can see most of it pretty significant drops. And so then they look to see what happened afterwards, after the market hit that drop. So that middle column, market returns, is what happened up to that point where the market bottomed and then it rebounded. So the winners versus losers, your crash. How did your momentum stocks perform relative to your loser stocks? So the winners are your stocks that did really well heading into the bottom of the bear market. Your loser stocks are the ones that did the absolute worst. And so they look to see what happened afterwards. And what they found out was those winner stocks that did well heading into the bottom underperformed. As you can see here, going with the first sell here, August 1932, coming out of that bottom, the winners underperformed the loser stocks by 74%, meaning that if you looked at the performance of the stocks that did worse going into the market bottom, those stocks that fared the worst going into the bottom ended up outperforming the stocks that did the best going into the market bottom by 74%. So a huge rebound, but you really saw those loser stocks actually do really well, and it caused the momentum stocks to really lag. So it wasn't so much these momentum stocks had lost money as much as they really trailed the stocks that did the worst going into the bottom. So it's really what did well going to the bottom really lagged once the market rebound.
And then we have a number of A+ investor subscribers who are attending the webinar tonight. And a couple of questions have come up are the value, momentum, and quality grades and scores that you're using for VMQ the same as they have access to in the A+ investor service?
They absolutely are, and actually VMQ actually was one of the genesis for A+. We wanted to give investors more tools, but we really use VMQ as almost a sounding board in terms of expanding our scores and think about some of the tools. The stock evaluators, extension of the VMQ analyzer. So yeah, we are actually the same actual score, same value score, same momentum score, same quality score. The difference is that A+ really gives you the tools to help you if you want to apply your own strategy, you want to do your own research, where VMQ is really, let's give you a specific approach, showing you how to use factor approaches So if you actually want to see how do we actually apply in a real life portfolio and have the ability to look over your shoulder, that's what VMQ does. So they complement each other, they share similarities, but again, A+ is really for those people who love to roll up their sleeves, do their own analysis, want all the access to all the tools, or VMQs want people who want to actually see how are we applying this in a real world portfolio. And I'll point out that VMQ, Stock Superstars, Dividend Investing, Shadow Stock, these are all real money portfolios. We actually do run these portfolios through actual discount brokerage accounts. So the performance you see are our actual returns after we factor in all our transaction costs.
And time slippage, things like that. And that's actually a good explanation. And I guess so if someone sees a more detailed explanation of, say, the value score in VMQ versus A+ investor, they're calculated the same way. It's just that you chose to have a more detailed explanation when you designed VMQ versus perhaps someone else in the office who did a A+ explanation for the value score.
Absolutely.
Okay, well, I'm gonna let you continue on your presentation, and I'll be here watching for questions.
Great, thank you, John. So before I was talking about how value and momentum pair well together, so I just want to show you this chart. So this is from S&P 500. This is from S&P, Dow Jones S&P. They actually publish what's known as a factor dashboard, and this is if you type in S&P 500 factor dashboard, you'll find this. They update this every month. And so what they do is they take the S&P 500 index and they actually separate it to different subset indexes. So you can see here I've highlighted the S&P 500 value, the S&P 500 pure value, and the S&P 500 high momentum value. So these are all subsets of the S&P 500. And you can see there's growth, there's quality, but you can see here that when you combine momentum with value, you actually get better performance than a pure value strategy alone. And so this shows you how well it pairs well together. And what's interesting is you can see the performance of high value momentum is pretty close to S&P 500 over the last 15 years. And if I went back 3 years ago, you would actually see the returns of high momentum value be a lot higher. So this is because of the so-called value drought has actually dragged down the performance, but you still get higher returns from value strategies by adding momentum to the risk. But now, as well as value and momentum pair well together, you still need more. If you just combine low value with high momentum, you're going to get a large number of stocks, really too many stocks for us individual investors to really sift through, and certainly more than we're really going to hold in our portfolios, and more than we really should hold in our portfolios. So you want to narrow down the universe of stocks and really narrow down that grouping to a universe that we can actually manage. And so one of the ways I think it's good is to actually use quality. So we found the stocks are cheap. We found the stocks have strong momentum. Now let's get rid of the junk. Let's focus on the quality stocks. And there actually is a factor that goes by the acronym of QMJ, and that stands for quality minus junk. So it means if you go long, you buy quality stocks, and you go short the junky stocks, you basically will have positive returns, and you'll have a return premium over the long term. So just as low value beats high value, strong momentum beats weak momentum, good quality beats weak quality. And so how do you identify quality? Well, like in a lot of things, quality is in the eye of the beholder. But it's interesting because if you look at different ETFs, you will find different measures of quality. So there's no agreement in an investing world exactly what quality is. We can find definitions of value. We can find definitions of size. We can find definitions of value. Quality is a little more obtuse, but we've looked across the universe. We've looked both at academia. We've looked at studies. We've looked at what the industry does, and we've come apart with what we think are really 8 good measures that are really used by a variety of investors and actually have research backing them up to evaluate whether a company is quality, is it junk, or if it's somewhere in between. And those measures are return on assets, return on invested capital, gross profit to total assets. So this is a newer indicator where basically it is actually popularized by Professor at Rochester, Robert Novi Marx, and he's basically looking at what's the company earning after you subtract cost of goods from sales and dividing that by total assets. And the argument for dividing that profit number, so he's taking a higher profit number, his argument, because it's before you take out all the operating expenses, things like depreciation, he's arguing it's a cleaner measure of valuation. And then he's dividing it by total assets, so you actually scale, so you can actually compare the measure across companies of different sizes. So it's a newer measure, but the basic idea is you're looking for companies that are more profitable relative to their total assets. Buyback yield is basically they're buying back stocks. Changing total liabilities, basically companies that are reducing debt are preferred. Accruals, where we're basically looking again, are their earnings more attributable to actually cash flow or to earnings? Because the problem with earnings themselves is their accounting figure, where cash flow is when our company actually receiving the money. And again, we're comparing that to total assets so that we can compare it against companies of different size. Now, the Z double prime bankruptcy risk score. This is basically a measure developed by Robert Altman. We'll put the interview I did with him in the show notes, but he came up with a measure to determine, is a company at risk of going bankrupt? Is a company at risk of going to financial duress? And he came up with a score. And basically the range is, it's safe, you don't have to worry about the company going to financial distress. It's in this gray zone where he uses the term errors are made. So it's not clear that the company's out of the woods or not. And then the company's at high risk. So basically we're looking for companies that are not at risk of going to bankruptcy. I think most people on this call would agree, yeah, give me the stocks that are not at risk of going in bankruptcy and let me avoid the ones that are at high risk. And finally, the F score. This is a Petrosky F score, and he looks across a variety of different valuation measures, and he sees how a stock compares on each measure, and then he assigns a score. So rather than looking at one measure, we're actually, again, looking at different measures to get a comprehensive overview. Is a stock a quality stock? And it's the same process we use for the value score. So we look at each individual quality trait. In this case, again, we're going back to Quanta, where you can see on its return on assets, it ranked in the 80th percentile, so pretty high. And so we took how it ranked on each valid measure, and then we took the average for all those value measures. So if we looked at all the valid measures Quanta Services has for quality and where it ranked relative to all other stocks. So for each measure, is it better or worse than all the other stocks? And then again, take the average of all those and come with a relative rank. You can see here where Quanta ranks in the 97th percentile. So in terms of quality, in terms of its fundamental strength, Quanta actually ranks really high relative to all other stocks. So very strong quality. And what we're really looking here is really to use quality as an overlay of value momentum. So we found the stocks with cheap value, strong momentum. Now let's find the stocks within that group that have the strongest quality about them. So we're really trying to actually weed out the junk. And so in terms of how we calculate it, we're actually, again, requiring 4 of the 8 measures. So to cast a wider net, we're not requiring a stock to actually have valid ratios for all 8. It's great when they do, but we've wanted to make sure this wasn't too restrictive. And to give some background, when I originally wrote my book, Better Good Than Lucky, part of the problem I had with my screens at times it would have been too restrictive. And especially when I tried to tweak the strategy, try to make little adjustments here and there, really made it too restrictive. And I realized that I was going after perfection. We have a saying in the office that perfection's the opposite of done. If you think about investing, you can look for perfection, or you can look for stocks that are mispriced. And really, as an investor, You're looking for good stocks that are trading at prices that are not reasonable, that are really reasonably below what they should be. So you're not trying to find these perfect stocks, because when you do find a perfect stock, chances are its valuation is going to be really high and its price is going to reflect that. So you're looking for stocks that have upside, is what we want as investors, not perfection, but upside. And so this is why we also cast a wider net. But again, we use this two-step process for finding good stocks. And so we're looking for stocks that when we look on average, yeah, this stock has pretty strong quality, and we don't have to worry about it being fundamentally weak. So we look for this, so we basically look for strong, for strong quality, strong momentum, and an attractive valuation. But we do overlay a few other characteristics. We want stocks to be profitable. We want the stocks to have a price of at least $4. The idea is it's not at risk of being delisted. It does require it to be exchange listed. We avoid foreign stocks. Nothing wrong with foreign stocks, but their accounting standards can be different. The way they report their financial statements can be a little different, and that can cause our methodology not to work so well. The same thing with financial stocks, particularly with our valuation measures. It doesn't necessarily work well with financial stocks, say like a price to book or a price to sales. So we avoid that. We avoid real estate investment trust because their corporate structure is different. There's absolutely nothing wrong with real estate investment trust. I personally own the Vanguard REIT fund. It's just that this approach doesn't work really well with the REITs. So we exclude them. Now, how do we put this all together? So I've given you a whole lot today. Well, the good news is following the VMQ approach is really simple. Just look at the grades. To have a stock added, we want the stock to have a grade of A or B for value, momentum, and quality. If it has an A or B across all those traits, and it passes these additional restrictions, it's a candidate to be added. Our sell rules are pretty simple. One of the three grades falls to an F. That's pretty much it. Obviously, the company stops being profitable on a rolling 12-month basis, meaning if it has one bad quarter, we're not going to penalize it. But if it continues to lose money, we'll kick it out. That's basically our rules. Now, with momentum, because we can notice momentum, it can be a more volatile indicator. I mean, we have seen stocks where its momentum's grade has dropped to an F, and then it's bounced. We will give stocks a little bit of leeway. So a little bit of bend, not break defense, so to speak, where we'll allow the stock a little bit of room to right now not to have excess of turnover. But if we're seeing that, yeah, this stock's momentum has really become weak and it's holding at an F, we will pull the trigger. Now, for those of you curious, we have sold on momentum grades of F. We have sold on quality grades of F. We have not had a stock in our portfolio go from a value grade of A or B to an F. I have had one in my own portfolio go from an A or B to an F. So stock really has to rise quite a bit to get to it, but it can happen. But again, there's simplicity to this, where it's just simply follow the grade. So even though we use a lot of industry research, a lot of academic research, and applying the strategy, we really want it to be simple for investors to follow, because strategies that are easier to follow are strategies that people are going to more likely to stick with. And so we combine this all into our VMQ stocks. You can find it at vmqstocks.com. You can actually reach it anywhere on sites. And it's a portfolio of 20 stocks. And again, this is run through an actual portfolio. You can see when we've bought stocks. You can see when we've gotten dividends. All our transactions are listed for it. And we also list the grades. We list the scores. We'll note with either an up or down arrow if the grade's improving or if it's getting worse. And you can see in our portfolio notes if the stock's at risk of being sold, we'll let you know. You'll also note the term qualifying. So if a stock's in the portfolio and it currently meets our buy criteria, we'll tell you, yes, the stock is still a candidate to buy. It still meets our purchase criteria to make it easier for the portfolio to follow. So what types of stocks do we hold? Well, I went back, I looked at the portfolio since inception. We started the portfolio in 2018 just to see characteristically what kind of stocks that we hold. About 40% of the stocks have either been the S&P 500 or the mid-cap 400. So we've had some pretty large stocks. Currently, we hold stocks like Target, United Rentals, so pretty big companies. About 40% have been the S&P small cap 600. So 80% of our stocks have been in approximately the largest 1,500 of all stocks, which means the other 20% have actually been smaller. So I talked about the size factor earlier. One of the benefits about being an investor is that we're not limited by size. So we will go down into the microcap universe. We use the shadow stocks criteria of a market cap of at least $30 million. So we're not afraid to go small in terms of size if it meets our criteria. As I wrote last week in Investor Update, there's about 4,000 stocks that are exchange listed that have a market cap of at least $30 million. So if you're an individual investor, you want to truly be an active investor, cast a wide net, because chances are there's stocks that have the criteria you want. You know, maybe it's VMQ, maybe it's some other criteria, but there's stocks that have the criteria you want that you probably have never heard of. So, you know, use our tools on AAII.com and find those stocks that are out there. Now, we do not purposely seek dividend-paying stocks, but it has happened that about half our stocks have paid a dividend. So we do have dividend payers in our portfolio. It's not a requirement. We don't purposely seek them out, but if they pay a dividend, you know, that's like icing on a cake. We're always happy to have dividends-paying stocks, but again, it's not a requirement for our portfolio. And for those of you who really are diehard dividend investors, I will say we do have our dividend investing portfolio, which you may want to consider looking at. And finally, I want to point out to you that it's not just our portfolio. We publish a list every day of the stocks meeting our criteria. So if you like the idea of VMQ, but you know you want to apply it in your own way, maybe you want to favor low valuation, maybe you have a preference towards strong momentum. Every day we publish an updated list of all the stocks meeting our purchase criteria. We call it VMQ Ideas, and you can download it. And again, it's every stock that passes our criteria. Now, not every stock on this list will make it a portfolio. Because we're using a real money portfolio, we're limited to 20 stocks. And we hold 20 stocks at once, which means for me to add a stock right now from the VMQ Ideas list, I have to sell something. But again, you as an investor have the ability to go through this list if you want. If you like the VMQ methodology, but you want to apply it in your own way, here's the full list. So you can actually go through it and use it for yourself. And real quick, so I'm showing you this list. How do we select stocks? So you'll notice on the screen in the upper right-hand corner, there's a little link there that says Excel. And I realize it might be a little small on your screens. But I actually go through and I sort the list. So I look for the stocks that have the lowest valuation. Then I resort the stock and look for the stocks that have the strongest momentum. So I'm really looking for the stocks that have the combination of the lowest valuation and strongest momentum. And that's the first stock I look at. And I do this time after time, looking for that stock that has the best combination of lowest valuation and strongest momentum. And then I do some due diligence. I start looking under the hood, making sure there isn't something about the stock that would give me cause for concern that's not necessarily picked up by the screen. Some of the reasons why we might exclude a stock, if there's dual class ownership, we just try to stay away from those, particularly when we see one investor or a small group of investors have voting control. That means it takes power away from us individual investors. Occasionally, we've seen what is a forthcoming merger. It's hard to screen it for stocks that have just agreed to be merged. So we look for things like that. Maybe perhaps there's a sizable drop in future earnings that's not being picked up. So quantitative strategies are really good, but you still need to take that extra step just to take a look under the hood and make sure there's something that you didn't miss. And it doesn't matter if you're using VMQ, using CanSlim, some other approach. Take a few minutes, do additional research. I go to the SEC's EDGAR website and I look at the 10K, an annual report filed by the company, just to look through, make sure there's no big risk. I'll also go look through the company's news and just make sure something hasn't popped up, either the company's investor relations website, certainly if you have a news website of your choice, just looking for those red flags just to dot the I's and cross the T's. But I will say, as much as possible, I trust the model. And I said all the time at the office, you've got to trust a strategy. If you have a strategy that's been proven to work, that's evidence-based, that's systematic, then you need to trust it. Don't try to override it. Where your outperformance will come is from trusting that process and repeating that process over and over. And again, a process that is evidence-based. Now, just a few final thoughts, and I'll take some more questions. One, again, just getting back to this concept that if you want to beat the market, you really have to be different than the market. You need to embrace truly being an active investor. And realize that if you're going to truly be an active investor, you're going to have a portfolio that's going to look different. You're going to have a portfolio where you mention to your friends might look at you and say, you're investing in what? But that's where your outperformance is going to come from, is from being different. But it does mean your returns will be different, which means you will have periods where you underperform the S&P 500. And again, that's a feature, not a bug, because it makes it harder for other people to stick with it. But it does mean that in turn, your strategy over the long term, you'll be rewarded for being different, and you'll really have that huge upside over the long term, which will make the pain of enduring periods of underperformance all worth it. It's really going after that big long-term upside where you really see a big difference in wealth, and you'll be really happy you did it. And realize when you look at strategies like VMQ, where you combine different strategies, it is a feature. It's not as nice as that narrative of I'm buying this stock because I see this story. It really is about using the academic research. And because some people don't necessarily find it intuitive, it keeps them away. And the paths that seem a little bit less unpopular are really the paths to investing that will really lead to higher long-term returns. So again, just getting back to this notion, I know I've been hammering it today, but really just think about how can you be a different investor, an active investor, but doing so in an evidence-based, systematic manner. John, any additional questions?
Sure. I'm sorry we've gotten a little bit late, so we'll take questions for 10 more minutes. And thank you everybody for your attention and the good questions that have come in. So Charles, you're presenting share buyback as a value measure. A person here is perhaps thinks that maybe our buybacks perhaps a cheating way of pumping up a stock price, and if so, why is it a value measure?
Yeah, absolutely. Share buybacks are very controversial. A lot of talks, a lot of people have discussions about what is the best use of corporate cash. You'll hear arguments for and against it. But the research shows that companies that have a net reduction in their share count actually outperform. And it is a measure of whether or not companies are returning capital to shareholders. Now, there's arguments that companies should put the money back in the business. But you can look at the flip side is, I'd rather have a company buy back its share than waste its capital on a merger that they're just doing to so quote unquote build the empire. But the research does show that companies that buy back shares do have outperformance, and that's why we actually use it.
Perfect. Yeah, so it's a good predictor of, it has been shown to be a good predictor of future stock price performance in that context. And so actually, and shareholder yield, which combines dividend yield plus the buyback yield, if a company is issuing new stock, which is dilutive, it will actually be penalized for issuing new stock.
Absolutely.
A couple of members here have used the VMQ service. They're looking at the numbers, and they understand the grades well enough. They know that an A grade is good and an F grade is bad, but they get a little bit confused with the scores sometimes. Are there scenarios where high scores are good and low scores are good in other scenarios? And if so, how should they use scores, or should they just focus in on grades?
So the simplest approach is just to focus on the grades, but the scores are percentile rankings. And where I think confusion happens is that opposite, their value and momentum are opposite. So for value, you want stocks ranking the lowest decile, because those are the cheapest stocks. So a stock whose price to book ranks in the bottom 24th percentile, that'll be the cheapest stock. Whereas a stock whose price to book, say, ranks in the 90th percentile, that'll be the most expensive stock. So we're really looking, that's why value has low scores are better. Whereas with momentum, you want stocks with high relative strength. So stocks whose relative strength stays in the 80th percentile has outperformed a stock whose relative strength ranks in the bottom 20 percentile. So it's basically where cheap value is better and strong momentum is better. So they're really opposite. So if you think about just valuation, price to book of 1 is cheaper than a price to book of 5. So in this case, lower is better. For momentum, a stock that has a relative strength rank of 87, which means it's outperformed 87% of all companies, is better than a stock whose relative strength is, say, 23, a stock who's only outperformed 23% of all companies. So that's where the difference is that they are different indicators. And that's why for value, you do see lower scores being better, and for momentum being higher scores is better.
So if ever confused, look at the grades. It kind of simplifies it.
Absolutely. And that's just, like I said before, you really don't have to pay attention to the scores if you want. They're an added layer of detail, but it really is a matter of just A, B, C, D, or F, and just using that and not worrying about the scores, and you can absolutely follow the system.
Well, a follow-up question to that is if a stock has A grades for all the factors, what would you use as a tiebreaker?
So I actually would use the score in that case, and I actually do consider the scores as a tiebreaker. But the other option is if you don't want to get a detailed score, in that case you could take a look at your portfolio and is there a chance to diversify my portfolio, say by sector or industry? That would be the other option to do it. So if you want a simplistic option, I own a lot of retail, and this is an industrial company, for instance. Let me add that. That would be a very simple way of doing it. You'd still get exposure to those factors. The scores just give you more detail, ability to really, get more into the weeds and really customize if you want to. But when we tested it, we didn't get into minutia of one score over the other. We really looked if stocks are in this range, does the portfolio outperform? And the research really shows buy a bulk of stocks that are really cheap, buy a bulk of stocks that have strong momentum, buy a bulk of stocks that have strong quality. Don't worry if this stock's marginally stronger than that stock or marginally cheaper than that stock.
And a question here is, how long do you normally hold your positions?
So, it varies by the stock. We have some stocks in our portfolio, really almost since we launched the portfolio in 2018. We've had some stocks we turn over quicker. Whenever we add a stock, we actually use an initial 6-month holding period, just to make sure that we don't have really excessive short-term trading. And the idea is to prevent, because momentum can change, the idea is to prevent excessive trading. And so we found that works really well, and sometimes the initial 6-month period has worked really well. I'll give you an example from a portfolio. Sally Beauty Supply. They're a beauty supply shop. They sell to a lot of hairstylists. They sell to consumers. They're doing really well on hair color. From what they tell us, vivid hair colors are really in style. I'm obviously not in a demographic that would know that, but when we first added it, when you had the spiking in coronavirus cases, that second spike, stock got dragged down. But because we had that 6-month rule, we held on to it, and the stocks really come back by a large amount. And as the markets become open, as we start to see the pandemic hopefully recede and more people get their vaccines, hopefully the company will have a good outlook for it. So, but that's an example of where we having that 6-month rule gives the stock some time to breathe and actually go out from there. But after 6 months, we can sell a stock. Some stocks do get sold for less than a year, but we've had other stocks, like I've said, we've held for over 2 years now.
In an era where transaction costs, at least commission costs, are zero, what's wrong with excessive trading?
Well, the idea is whether or not you're right. Well, first of all, I guess there's 2 ways of answering it. First of all, if you're a taxable account, you could rack up excess trades and excess capital gains. But the other thing also, if you're constantly trading, you do run the risk of more and more mistakes. And you really want to make sure you're not selling just for the standpoint of selling. You really want to make sure you're selling because you're applying your strategy in a very systematic manner. And some strategies do call for shorter trading. We found when we tested the VMQ on a 6-month and 12-month holding basis, it really outperforms the market. And we have evidence for value, for momentum, that using 6 or 12-month holding periods actually works really well. So the research we've seen says don't do short-term trading, actually hold on to it and use it, because the research really looks at forming a portfolio and holding it for these 6 to 12-month periods and buying more than one stock and using those trading periods. So we're actually using evidence-based research when we use the 6-month rule, both our own testing, but also looking at the research as well.
And in terms of wanting to look at the performance of VMQ and your back testing, the best place to get that would be to go to the VMQ website?
Absolutely. You can actually see our performance on our website. The back testing, we did it, the back testing is now old. We did it a while ago. I'll give out my email, charles@aai.com. Somebody can email me. I might ask for a few days before I get back to you with the sheets, but I can actually find a summary of our back tests for those who want to do those. Keep in mind, from the original, after we did the original back test, however, we did revise the momentum score. We actually revised the quality score as well, but I can actually provide a chart showing our back testing for the revised quality score. And you'll clearly see that quality scores of A did better than B, than C, etc.
And we have time for just 2 more questions then. In terms of, why wait till a grade goes to F before selling?
So in the research we found out is where stocks really underperform, it's really in the bottom quintile. So if you look, say, like value momentum, you'll see really good performance for the top, and even for the top 40%, you see this outperformance. And you start getting into those middle deciles, and performance is close to the market, maybe a little bit below, but then right at the very end, you see this huge drop in performance. So where you really see this weakness, where there's value momentum, it's really that bottom third and really that bottom 20% is where you really see the weakness in performance. And so that's why we based the rules on that, is really using those rules. And again, also we are trying not to have excessive turnover, but the research really says is what really get to that bottom, really that bottom part, it's really where you want to make sure you're getting out of the stock.
And we'll close on this one. What is my first steps if I want to follow your VMQ portfolio passively?
Well, I would say, if I always encourage people to read through our FAQ, read through the Getting Started guide. But if you're ready to dive in, go, look at the portfolio and start with what's listed as qualifying now. Again, those are the stocks we currently hold in the portfolio that still qualify for purchase. So those are the stocks I would suggest looking at first. But we all encourage every investor to still do their own research on the stock and make sure it's right for their portfolio. So VMQ, as are the rest of our portfolios, they provide examples of how we're using academic and industry research and really evidence-based approaches in a real-world portfolio. But we want to make sure that everybody who follows them understands the strategies and are comfortable with the stocks they purchase.
Well, great presentation, Charles. Really enjoyed it. Thank you so much.
Thank you, John.
Charles, if you mind advancing the slides, we want to talk a little bit about the offer for attendees.
Yes.
So if you're not interested, if you are not currently a subscriber to VMQ Stocks, we do have a special offer. You can go to that URL, tinyurl.com/VMQ offer. You can find out more information about VMQ Stocks, the strategy, and tell all your friends. It's a great thing. As Charles, being the champion of it, he'd tell you it's also pretty great. So
absolutely. And this is a risk-free trial offer, so please, I encourage you to take advantage of it.
All right. If you could advance the next slide to
Sure.
So I'd like to talk about our upcoming webinars. We do these every Wednesday at 7:30 Central. Next week, we're going to be doing the next episode of the Individual Investor Show. We're going to be talking about small cap stocks in the context of our shadow stock model portfolio. as well as current trends in investor sentiment. Join us next week, February 17th, 7:30 Central. And the following week, February 24th, John Bukowski, who is tonight's moderator, will be the presenter talking about identifying promising companies with AAII.com's stock screens. He'll be talking about the stock screens area of our website and how you can apply those screening strategies from both the guru strategies and the factor strategies to your own portfolio and your investments. So with that, thank you, Charles. Thank you, John. And thanks to all of you who've been tuning in. And we will see you hopefully next week. We hope you stay healthy and wealthy. Take care.